Hello, this is Mike Regan, and I'd like to welcome you to another On the Record with TranzAct. This is one of my favorite things to do because our friend Gary Shilling is a noted economist, won more awards than you can shake a stick at. And we do this on a semi-annual basis now for the last 5-6 years. And it provides you with some great insights as to what's going on with the economy. As you'll learn towards the end of the interview, Gary also produces a monthly newsletter. And as a way of saying thanks to you for listening, we're going to post a number here that will allow you to get a complimentary edition of the newsletter so you can see what it's all about. And if you do become a subscriber, one of the things you're also going to want to consider is the fact that Gary is famous for producing the best honey in the world. So that's one of the reasons, in addition to all the great advice, if I don't like the advice, at least I love the honey. So welcome, Gary, to this On the Record. So let's dive right in. And Gary, I brought out my decoder ring for this particular interview. We've been doing these interviews for several years. Typically, we do them semi-annually, but help us understand what is going on with this economy.
Well, the economy is probably in the final stages of an expansion that started in the middle of 2009. We're seeing increasing signs that we could have a recession perhaps this year. I think there's probably a 2/3 chance of recession, 1/3 it'll be simply slower growth. But you look at things like the declining stock market, that's always a forerunner of recessions. Tightening by the Federal Reserve, that's very typical. You see commodity prices declining, that happens. Consumer optimism. Consumers are always optimistic at the top of the economy. They're 2/3 of the total GDP. So when they turn down, the economy turns down, but their confidence is starting to slip. There are a number of factors. Internationally, of course, we got the trade wars that Trump has trumped up with China, and then emerging markets. These economies. You're looking at Turkey, Argentina, etc. They borrowed tremendous amounts of money earlier in dollars. Now the dollar is strong, so it takes a lot more of their local currency to repay those dollars, and also they import commodities, and most commodities are priced in dollars. 42 out of 45 in our list, and that means that they got to pay more currency. Just an example, Turkey, their lira, their currency, has declined to the point that even though crude oil, the internationally priced crude oil, is actually down in dollar terms from the beginning of 2017, it's up over 50% in Turkish lira terms. So you see a lot of disruptions there. So there are a number of factors here. Now, let me just say, following up on that, there is no absolute clear sign that we're headed for a recession. I think the odds favor it, but normally recessions start from one of two causes. One is the Federal Reserve tightens credit to the point that they really kill the economy. They'll get there sooner or later, but there's so much excess liquidity around the world. I think it'll probably take them at least a year at the rate they're going to get there. And it looks like they're pausing now with the economic statistics looking kind of weak and stock market sell-off. The other cause is a financial crisis. And we had in 2000, when dot-com stocks, which were soaring, this was stocks the puppet, when they collapsed. And then, of course, in the mid-2000s, when subprime mortgage, when all that bonanza, this collapsed and gave us the worst recession since the 1930s. You don't have either that overblown situation, that bubble waiting to be pricked. And as you know, Mike, I've made a career out of looking for those bubbles and had pretty good success. There isn't any of those that are clearly in evidence, and the Fed is probably not quite there yet. But you put all these things together, and I think we probably are in the final stage of the economic expansion, and a recession is looming.
Okay. Gary, when we talked 5-6 months ago, we talked about the potential for a trade war. The 301 tariffs have been postponed for 90 days. Those were going to come on to the tune of an extra $250 billion. You said that you didn't see this trade war scaling out of control, that China was not going to alienate its largest customer. They couldn't afford to. Here we are now, middle of January. Are we rethinking that? Is it when the 90 days comes up, the end of March? Any concerns that this thing may go sideways in a big way.
Well, you never know because Trump is unpredictable and he prides himself on being
Really?
unpredictable. but what has happened in the meanwhile is that China's economy is slipping. The growth rates are slowing there. Their export growth is waning. Part of that is the tariffs. They have huge debt problems. They're trying to reorient the economy away from growth by infrastructure, and that's resulted in ghost cities, excess capacity, huge debts to finance it, and exports. They want to reorient toward the consumer, but they're not having much success at that. So I think that the situation for China is much weaker than it was 6 months ago. So they're probably even more willing to strike a deal. Now that doesn't mean that President Xi of China, and he's sort of president for life, he made himself that, and Trump aren't going to go to the mat and we get an all-out trade war and a serious global recession. That's certainly possible. But Chinese tend to be pragmatic, and they got a lot more to lose than we do. We're basically a domestic economy. Our exports are 13% of GDP. In China, they're over 20%. In other words, they're much more internationally oriented. And when you get into a knockdown, drag out, nobody's going to win. Maybe we'll be the valedictorian in summer remedial school, but we're going to be a lot better off than the Chinese, and they know that. So I rather suspect that what will happen is, as we discussed actually 6 months ago, that the Chinese will increase their imports from the U.S. They will demand less in the way of tech transfers, the cost of doing business in China, and they will back off from stealing technology. But having said that, China is determined to be a leading global power, if not the leading global power. And the way they see themselves getting there is through technology. And where do they get that technology? They get it from the West, from North America and Europe. So they haven't really given up on this. And of course, that's been the problem with China. When China joined the World Trade Center at the end of 2001, they promised to be good boys, to open up the economy, to play by the international rules. And of course, all they did is temporalize, postpone, and the West basically went away. I think Trump realizes that, and he's really saying, right now, we got to see concrete evidence. We got to see verifiable truth. You know, President Reagan said, "Trust but verify," and Trump is very much in that vein. So that's really the sticking points now. It isn't that Chinese aren't going to promise it. It's can they do anything that's going to convince the administration that it is for real? And what are the signposts? How are they going to set this up so if China doesn't come through, then they can increase tariffs overnight or whatever to make sure there is compliance?
Okay. You know, Gary, let me take a step back for a moment because you talked about a recession, you know, the potential for a recession here in the United States. You know, there's a lot going on globally. In each one of our interviews, you mentioned, you know, the global issues. We've seen Brexit, you know, a significant loss for Prime Minister May. And we see, you mentioned Turkey, you mentioned Italy, you mentioned other economies. I saw an article here recently which highlighted the fact that Germany, the German economy is got some concerns. Do you see anything that would lead you to be concerned about macro events on a global level that could have a worldwide economic impact?
Well, I think they are already there. If you look at a group of 33 major countries, they're under an umbrella of what's called the Organization for Economic Development and Cooperation, and their leading indicator collected from all those economies and some of the minor ones has been turning down in the last 6 months, and it's got a pretty good track record. So and as you say, there's certainly plenty of evidence. Germany, very dependent on exports. A lot of them go to China. So with weakness in China, they're seeing their economy atrophy. So yeah, this is really a global situation. It just isn't the U.S.
Okay, so Gary, let's go forward in terms of speak to those people that are, you know, running businesses, managing large supply chains and everything else like that. Give us a forecast for 2019. If you were sitting in their seat running these organizations, what would you plan for?
I I think they are for a weak economy. We're already, but the one that I think is probably least appreciated now is consumers. I mentioned earlier, Mike, the spending, consumer spending activity, and consumer spending has been strong. But if you look beneath the curtain, what you see is that consumer spending has been not been supported by growth in income. It's really been financed by people drawing down their saving rate. Now that can't continue indefinitely, and we are beginning to see some cracks there. But I would rather suspect that's the area that we ought to keep our eyes on. And if you start to see decided weakness in the consumer, then I say it's really hands down a recession.
Then batten down the hatches type recession?
Could be, because the thing, and I mentioned earlier, there isn't a huge financial crisis waiting to happen, and the Fed has not got rates high enough yet to do the usual deed of precipitating a recession. By the way, by my count, in the post-World War II period, when the Fed starts to raise interest rates in 12 of 13 times, they've got a recession. The only soft landing was in the mid-90s, and now they're not only using interest rates to tighten up, and they've used interest rates for over a century. Now they're selling off this huge portfolio, which they accumulated with quantitative easing. They've never done that before. Well, given their lack of success with interest rates, what are the odds that they're going to pull it off with unwinding the portfolio as well? As I say, those are definitely there. But as I say, those are the things that you have to watch in the longer run. But as I say, right now, I'm watching the consumer.
Okay, Gary, it wouldn't be a Gary Shilling interview were it not for the topic of deleveraging. It's something that you've studied, written books about, and I think maybe your middle name might really be Gary Deleveraging Shilling. But that said, you mentioned, if we go back, and I interestingly enough checked one of the interviews from 4.5 years ago, you said that we would pretty much be through the deleveraging cycle by 2017, 2018, maybe a little bit later. Has that deleveraging cycle run its course?
No, it hasn't. And you're right, Mike. I wrote a book called The Age of Deleveraging, Investment Strategies for a Decade of Slow Growth and Deflation. I wrote that in 2010, and I suggested there it might take about a decade. But so far, it's behind that schedule. Let me give you an example. If you look at consumer borrowing, and this is borrowing on mortgages, credit cards, student loans, almost any kind of legal borrowing in relation to after-tax income, and you always have to have a denominator to put things in perspective. That ratio was 65% back in the 60s and 70s. In the early 80s, it started to shoot up. It got to 130%, 65 to 130. It's now back to 105%. It's still a long way from that norm, and I'm a strong believer in reversion to norm when they're well established. So I would say we're partway there, but we haven't really completed the job.
Well, Gary, I'm a little bit confused, but let me put on my CPA hat for the benefit of others who may be wondering, what is that 65, 105, 130? You're saying that's the percentage of debt to their earnings.
Yeah. If you look at, you can't look at many economic numbers in their raw form, because the economy grows, people naturally, incomes grow, borrowing grows. That's the normal course of things. But when you want to see, are you departing from norm, you need to have some kind of a denominator. You compare it with something. And in this case, we're comparing the consumer debt outstanding to their after-tax income. And why after-tax income? Because that gives you, that's the money out of which they got to repay that debt. So that's why that ratio. But one of the things I might add here, we're talking about, what's going on. I think probably the greatest risk here, Mike, is complacency. We've had this very long expansion. It's been slow. It's the slowest in the whole post-war period, but it's lasted, from middle of 2009 up until it's probably still intact, at least for another quarter or two. very long expansion. We had a rip-roaring stock market funded by Federal Reserve money. That started in March of 2009. I think it probably ended this year when the dust settles. But I think that long period has evoked a lot of complacency, and there's probably a lot more borrowing, a lot more leverage, a lot more risk-taking, and again, lack of this deleveraging that you brought up that has yet to go. And we may see a lot of that come out of the woodwork when the economy does start to turn down. We see a lot more debt out there that is just not visible.
Okay, Gary, let's switch gears a little bit. And one of the things that over the past couple of months, for people who are reluctant to go on roller coasters, it kind of makes you question the wisdom of remaining in the stock market, because that's been a real roller coaster. Okay, so I've got 3 questions for you on the stock market. Okay. What is causing these wild gyrations? B, are we going to reach a landing area where we will, quote unquote, get back to a more normal, fluctuation? And C, looking 12 months out, 24 months, what are you seeing in the stock market?
Well, let me preface all that my answer, Mike, by saying if I really knew what was going to happen in the stock market, you and I wouldn't be talking here. I'd be making so much money with my own forecast, I wouldn't need to talk to anybody. But having said that, that's a disclaimer. But having said that, what's caused this? It's been a combination of things. I think it's all these indications of a possible recession, including the slowdown in housing. It's been the stock market decline. It's been the Fed tightening. I think it's been the combination of these things, and the fact that stocks are very expensive. When we went into this, you go back to the beginning of last year. I mean, stocks were selling about 45% above norm if you look at long-term price earnings ratios. So stocks were priced, as they say, priced for perfection. So you really had a very vulnerable situation, and then you start to see all these signs, and I think that's what give you the sell-off. Now, do you reach some kind of a plateau? Yeah, you can have stock markets and recessions that start and stop and restart. I mean, the 1973-75 recession, which we're lucky enough to be on the top of it, was a massive inventory correction. Inventories have been built up in the early 70s. It started in late 73, but then the economy actually rose for a quarter or two, and then it really collapsed when inventory liquidation got underway in late 74 and 75. So you can have a start, stop, and the same thing with the stock market. I've got a bunch of quotes on my wall, and one of them is that the stock markets are designed to take the most money away from the most investors. I mean, there's an insidious aspect of this, and anybody who thinks they knows what they're doing is usually about to really find out otherwise. Longer term, yeah, I think if we look out 24 months, you'll probably see stocks higher than they are now. In other words, intermediate, you could have another 20, 30%, 40% decline. Certainly possible. Now, you say, why not buy and hold? Why not just wait? And by the way, my good friend Jack Bogle, who just died yesterday, was very much an advocate of this. He's, founder of Vanguard, the idea of buy and hold. That's fine if you really stick to that and you're that kind of investor. But the reality is that very few people do. If you look at mutual funds, the mutual funds do better than the investors in the funds. They say, why is that? Well, it's because people basically they panic right when stocks start down in a recession. They don't get out until it's well underway, and then they don't get back in until the recovery is well underway because they're too scared. So you find that people, and that's human nature. Now, if somebody has, absolutely cast iron stomach, or is going to leave for Hongo Bongo and say, I don't care, I'll invest in stocks and wait 5 years and I'm sure it'll be fine. That's probably good, but very few people are in that position. Human nature promotes cycle. There's nothing else that really promotes cycle except human nature. So I think, although if you really did want to look out 2 years, you'd probably be at least as well off and maybe better than now. But in the meanwhile, it could be a pretty scary ride.
So patience, fasten your seatbelts and patience, and don't stand up while the roller coaster's going, right?
Yeah, right. Right,
So,
right.
Gary, let me.
The roller coaster go off the tracks occasionally.
What a cheerful thought. Thank you, Gary. Anyway, let me move on to one other area we typically cover in each and every one of these interviews. A friend of mine who's a very, very successful bond trader will at times basically not exit the market, but go to cash. And he says the times when he wants to do that is what he refers to as headline moving markets, where the emotions and other things like that trump the fundamentals. And, basically it's at that time where he'll stand down and get off to the sidelines until the market reverts back to a more normal behavior. With that thought in mind, and I've mentioned it a couple times already, today, like with Germany and Brexit and Turkey, and are there other headline or potential headline moving events that we ought to keep our eyes open for?
Well, certainly what happens with China, that could be either that they basically don't get anywhere with the negotiations, or they do strike a deal one way or the other. That could be a headline mover. I'm not sure it changes the basic economic situation. The Fed, if the Fed looks right now like they're on pause, or they're going to wait. But if the Fed, let's say in the next month or two, started to cut interest rates, the initial reaction in the stock market would be, hallelujah, stocks would go up. But then you say, why would the Fed cut interest rates? Well, they're probably cutting interest rates because they realize the economy's in trouble. So that could be a head fake. So you have to be very careful. And I too believe that whenever the fundamentals, and I'm very much looking at it from the economic standpoint, the political, the financial, the economic sphere, in developing a forecast, and then we see what investment themes drop out of that, and that's what we do, is managing portfolios, and we do manage other people's money. We're a registered investment advisor, but that's the way we do it. But the interesting thing is about declines. We did an exhaustive study going back to right after World War II of when you ought to be in and when you ought to be out of market. Now, say somebody who wants to be in all time and really just is truly committed and never going to panic, hey, that's certainly one strategy. But it's also true that stock market declines take place a lot faster than rallies. As you can see in a year's bear market, erase 3 or 4 years of gain in the previous bull market. And we did some studies, and one of them was really indicative. It said, even if you were out of the stock market in the last quarter or two before the peak, and then stayed out and until the recession was over, you'd be better off than if you rode it out all the way through, including that last blow off, which could be spectacular. So it's as I say, there are different approaches to this. I tend to think that if you keep your wits about you and look at the fundamentals and decide at what point they're telling you the economy's in trouble, and you look at what's happening on top of that, hey, there's good reason to be out of the market or to sell short, and we do sell short some things in our portfolios. We think they're really going down.
One of the things, Gary, and I don't want to steer this into the realm of the political theater, but obviously with a shutdown and, the comments about Chairman Powell and, the Fed and this type of thing, do you see any issues there that we ought to keep our eyes on?
Well, I think that when Trump first started off with this unpredictability, studied, keep them off balance attitude and so on, it was a shock. Now it's sort of become standard, and I don't think people pay much attention to it. I mean, you saw, for example, all the big cheering when he got together with Kim, the dictator of North Korea, and of course then North Korea back down. Now North Korea, they're saying we'd like to meet again and so on. But that's a long way from any agreement. So I think we're getting to the point where all these things that Trump says, he said we're going to pull out of Syria. Well, we've had some people unfortunately killed there in the last few days, and whether we do that as rapidly as he suggests is another question. Government shutdown. He wants his border war, and he seems to be wanting to go to the mat, but shutdown hasn't really affected that much of the economy. I mean, some of the government workers haven't gotten their checks, but they'll get them later, and they basically get another vacation in the meanwhile. I think a lot of these things, there's a tendency to jump up and down on a short-term basis, but call this a lot of investment people call this noise. You want to get away from that random noise. You want to keep your eye on what's fundamentally happening. And a lot of these ephemeral things you simply cannot get carried away with, in my view.
And that's reverting back to what we just talked about. But what you called noise, my buddy calls the headline moving issues, which distract from the overall rational fundamentals. We're as we wrap it up, Gary. 2019 Fed interest rate hikes. Reading some of the data points saying that they were a little bit surprised that with wages going up, that inflation didn't move in the traditional lockstep way. So are we, and also I guess the shock associated with the impact of one relatively minor, increase. Do you see any Fed increases occurring in 2019?
Well, it looks like they're going to hold off, but I don't think they're through. If you look back at Chairman Powell, they just released the transcripts of the meetings in 2013. They do that with a 5-year lag, and he was very clear in there. He was very much against quantitative easing, was taking Ben Bernanke, then the Fed chairman, to task on that. I think he really feels they ought to have higher rates, and they want to have rates high enough when the recession comes along, they got something to cut. And they also are concerned about low rates fostering a lot of speculative investments, people moving into hedge funds, into leveraged loans, into private equity, into commodities, and so on. And so the Fed, I think they fundamentally feel that interest rates ought to be higher. And unless the recession really unfolds here, I think they will increase rates this year. Now, the markets are saying there's a 69% that they increase them no more than once this year. That may increase later. I don't think they're really through with this campaign. If they backed off, I think it would, at least by historical precedent, only be because a recession is clearly in the offing or already there.
Okay, then let me you raised something here that I think a lot of people would be interested in your perspective. Lord, may it not be, but if we do enter into a recession, some of the traditional tools that we've used to fight recessions, as a dear friend of mine and another economist pointed out, we kind of unloaded our ammo getting out of the recession of 2008, 2009. There's not a lot of ammo left in the kit to respond to a future recession. You can't really cut interest rates too much. The quantitative easing is taken off the table. The issue of injecting the economy with funds and this type of thing. What are some of the tools to look at if, in fact, we were to experience some type of recessionary environment?
Well, there isn't a lot. Now, of course, they can spend more money on the fiscal side, but the deficits are already a problem. And, of course, the risk is that people are so scared about high deficits that whatever spending is taking place, that sentiment offsets that. But that you probably get. I mean, Congress is a very political body. They always are looking at the next election, and I think you could expect that. The Fed, they would probably cut rates, but again, they don't have a lot to cut. Their range is 2.25 to 2.5 on this overnight Fed funds rates, which is their policy rates. They could go to zero, but the Fed has basically said they don't want to go below zero. Now, the European Central Bank and the Bank of Japan actually have negative policy rates. But the Fed, I think.
What does that mean? What does that mean? That means if I want to park my money at the bank,
you got to pay. You got to pay for it. Yeah, you got to pay for it. Now,
I just wanted to make sure that the audience was aware of that. I mean,
Oh yeah,
you
no,
say
no,
negative
that's
rates,
right.
and I'm kind of going, wait a second, this isn't
Well,
adding up.
see, the theory was that the banks would just want to get rid of that like a hot potato. I don't want that money because I've got to pay to hold it, and that would encourage lending. In actual fact, particularly in Japan, it's had the reverse effect because people say, hey, I'm losing money on my investments, so I've got to save more for retirement. So rather than borrow more, they borrow less and save more. Just has, and the Fed, I think, have said that didn't work. We're not going there. So they are what they call zero bound on interest rates. So they
It's
don't have
kind of like a storage fee for money.
Yeah.
If you want to store your money at the bank, you pay a okie dokie. So, wow. But getting back to the question, what tools do they have to fight any kind of recessionary moves?
Not a lot. There's always the moral suasion. There's always the get out and tell the public that everything is just fine, and we'll tough it out, and think recovery's right around the corner. That kind of thing. Tomorrow and tomorrow and tomorrow. But there really isn't an awful lot they could do, and this is pretty well recognized. And I think that's one of the reasons that a recession right now is of more concern than normal, because you simply don't have the big offsetting tools. By the same token, there isn't a big financial excess there to be corrected that would say it would be a terribly deep recession, although you don't know what would happen. I mean, with the trade wars, with the emerging markets heavily leveraged, as I mentioned earlier, with a lot of borrowing, we may come out of the woodwork that people are much more heavily leveraged than realize. The downside is certainly not clearly defined, but you don't have the kind of thing like the housing subprime mortgage excess that just said, boy, this is going to be a humdinger.
Well, as we kind of wrap it up, Gary, just a couple more questions. You said we don't have the bubbles, but yet companies like Apple have really taken some rather significant hits. Could that be kind of a catalyst for other industries, or in particular tech stocks, getting whacked here in the foreseeable future?
Yeah, could be, because of course you've had such a huge rally in tech stocks, and whether they had earnings to back it up or not, were not important to investors. So they could probably sell off, and they have been the market leaders in the last few years. Another area that I'm particularly interested in is Bitcoin. And full disclosure, we're short Bitcoin in portfolios we manage, and I think that is just a giant Ponzi scheme. Bitcoin doesn't really have the characteristics of money. You can't use it in exchange. It's volatile. It costs you money if you want to trade it, and it's a black box. The guy who created it, you don't know who he is. He works with a pseudonym, and also he says there's only so many of these that are ever going to be created. Well, who knows? But now the Bitcoin is not big enough to sink the ship. These crypto coins, and there are a lot of them, are over 1,000 in existence, but altogether they're less than 1% of the money supply, the conventional money supply. So they're pretty small potatoes. So if that collapses, and it probably's got further to go on the downside, but that's not enough to sink the ship. But it is indicative of the speculative climate that we've had.
Okay. Let me turn the channel here and flip it back on you, Gary. Did I miss anything? Are there other themes? For example, one of the things I just want to encourage our listeners to do is we'll provide the link to the site to check out the investment newsletter. I've been a long-term loyal subscriber. My wife and I, we've kind of given up a lot of other newsletters, but Gary, for better or for worse, our oars are in your boat, as it were. So one of the other advantages, did I forget to mention that one of the other advantages of being a newsletter?
Oh yeah, you get a jar of honey every year.
You get a jar of honey. But what you have themes that come out in your newsletter. Did I cover most of them, or are there other ones?
Yeah, I think one thing we didn't talk about is logistics, which of course is you're very much involved in, and you're all aware of what's happening with online retailing and how it is affecting stores and changing the whole distribution channels, and that looks like that's going to continue. Nothing new there, but it does change the whole logistical situation. Another thing in that vein, of course, is the disruption with the tariff increases to supply chains. I think a lot of companies are now moving out of China. That's one of the reasons China's under pressure, is because they're moving their manufacturing from China to Bangladesh, to Pakistan, to Thailand, etc. So you've got changes that are going there, but nothing really new. But I think those trends are strong and they're going to continue.
Just as an FYI, Gary, obviously we track a lot of indexes. We in 2018, we were the first to call it back in 2017, the perfect storm. We upgraded it to a freight Armageddon. 1/3 of your S&P 500 CEOs by May had cited logistics and transportation as having a negative drag on earnings in their quarterly analyst calls. One thing that we are tracking that's it's kind of interesting. The truckload market seems to have settled down somewhat, but what we're also kind of wondering, you mentioned 73, 75, the inventory buildup. We're wondering to a certain extent whether the fourth quarter was impacted by companies getting ahead of the tariff issue. And maybe it slowed down a little bit when the 90 days, postponement was announced. But one of the things that, we are seeing are some concerns in terms of the freight numbers, which we've tracked going back to 84. We say freight and packaging are two of the indicators that kind of help you understand where the economy is going. And the freight numbers are suggesting at least a moderate to tepid economic growth. I mean, that may change on a dime. It could, but that is a fluctuation. But just as we wrap up, Gary, what's the current theme that you're kind of focused on, coming in the January newsletter and going forward? What is the common theme you think everyone ought to have their eye on the ball?
Well, I think it is. I think it is a prospect for recession. And as I say, you've got a lot of things already in place there. The Fed's tightening, housing is turning down, commodity prices are selling off, emerging markets are in trouble. But the U.S. consumer is really the final straw, if you will, and I think that's what we're looking at the most intently.
Okay. Hey, Gary, listen, I cannot thank you enough for your time.